I'm going to introduce somebody really who needs no introduction to our group. You know, Nathan and I started talking back in, probably early 2010. And a common friend in San Francisco had put us together. And I flew down just to meet him and go out to one of his dinners. So Nathan, he runs an institutional newsletter and only keeps 30 clients. These days it's a little bit fewer than that because he's also managing funds. And so we're a very privileged group of people to be the only retail newsletter that gets to have Nathan's expertise on a pretty regular basis. And he's been the cornerstone of the conversations group for the last year and a half. And he's going to talk a little bit today about some of the things that we've been talking about lately. Some of them where you should be putting money that's a bit different for this group because it's US focused. And someplace where you should not be putting money, which, as you all know from our time in the last little while, is natural gas. And he's got some updated stats here to give everybody. So again, he's here all day. So you may or may not, he might take his whole time here. And if he does, then he'll be here at 4:30 for questions and drinks. But Nathan, welcome. Thank you so much for coming. His first trip to Calgary.
Thanks. So if I can figure out the remote, today we're going to talk about trust energy, which will make more sense in a moment, and pass on gas. Read the disclaimers. I guess Keith pretty much did an introduction. I run a firm, Unit Economics. We do independent, hedge fund focused research. We limit ourselves to 30 clients. We're really selective in our coverage. Keith's been one of the 30 clients for some time now. Before we get into trust investing, though, in natural gas, I wanted to cover a topic that really hasn't had much press in quite a few years. In 2004, Merrill Lynch and the strategy team at Merrill Lynch published what they called an investment clock at the time. And it's really an eloquently simple methodology of looking at the investment cycle and figuring out what to own when and kind of how to identify the turning points and reallocate your portfolio. The basis was generally looking at economic growth. They used relative to trend, but you can just look at, is the economy growing or shrinking, and inflation. They divided it into 4 phases. So on the far left, you see what they called the reflation. I've renamed it the slowdown phase, with economic growth that's declining, inflation's falling. You go to Tim Hortons instead of Starbucks. Things are rough. The good news is energy and materials, which are highlighted in the green and yellow, are among the best performers. The bad news is they provide negative returns. You can also see down below in the market rankings, you make about 6% annualized. These are all annualized numbers during periods of economic slowdowns owning U.S. Treasuries. And there's supposed to be a minus in front of it, but minus 19.9% owning large cap, S&P 500 U.S. equities. When you move into the recovery phase, which typically lasts about 24 months, this data goes back to 1990, you find that growth is improving, but the Fed hasn't started raising rates. There's very little inflation. There's slack in the labor force. Oil's oversupplied. There's still plenty of slack and capex spend from previous cycles in the system. But stocks start to do well. Not only do they anticipate further growth, margins tend to expand greatly when you're not having to reinvest on the next thing or hire the next person because you're already overstaffed or overbuilt or, depending on your business, overcapitalized. In this period in the market, in this period of the economic cycle, stocks provide about a 15-16% annualized return. Energy and materials are about average, kind of mid-pack. Like we've seen recently, consumer discretionary, information technology do the best. But when there's a transition, as you move into the overheat, which the defining movement is when you go from continued economic growth, where economic growth doesn't translate into inflation, which is recovery, to you start to get a tight labor force, steel prices go up, oil prices go up. You start to get tightness in various sectors of the economy, which ultimately slow down growth. That's the overheat phase. And depending on the time periods, I happen to use since 1990, so energy and materials are kind of mid-pack. In Merrill's original study, they went back to the 1980s. They found energy was actually the #1 performing sector during the economic overheat period. And that typically lasts about 18 months. And then you go into stagflation where economic growth slows down and inflation's still going up. And you know. So turning to the next slide, where are we now? 2017 sector returns are shown on the left, and 2018 year to date. So we see kind of some similarities for both the recovery phase, which is on the left on top, and the overheat phase. But there's some signs, so energy returns were negative last year. That's typically not an overheat phase event. Energy overall is just up a couple percent this year. It's a pretty small return. So we're in the kind of midst of a late recovery, getting ready to go into early overheat, in my view. What's interesting on the timing and what could make this cycle interesting, particularly for U.S., being, arguably the main economic driver of global cycles. If we start, say in June, if we start an overheat phase that lasts about 18 months on average in June of 18, that would last through 19, and typically presidential election years are very strong economic years. And we're already starting to make the transition from monetary stimulus, monetary policy, to fiscal stimulus, fiscal policy. You can bet that as we near that presidential election, especially what's likely to be a very contested and controversial one, there'll be a lot more monetary policy coming down the pipe, a lot more fiscal stimulus coming through the pipe. And so I think there's a very good chance this becomes a protracted, kind of through 2020 economic overheat cycle. So, one of the things, Keith, part of the reason Keith and I have got along so well over the years is we have kind of a similar investment philosophy. And that is, find things that you have the potential to kind of provide, 50, 100% returns over a couple years, not necessarily this quarter. But also have limited downside for various reasons. The good assets, really good management team, conservative balance sheets, strong netbacks. I think the U.S. royalty trust kind of fit that, scheme or mental model quite well right now. So for anybody who's not overly familiar with the U.S. trusts, they're technically partnerships, so they're structured as investment partnerships rather than, stocks or bonds. In doing so, they have either depleting assets, so sometimes they aren't allowed to reinvest or redrill or buy new land, or a fixed expiration date. So on, for example, like June 30th, 2026, the trust dissolves. In a lot of cases, both. And then they're also required to hand out the majority of their cash, which is usually interpreted as kind of 90 or 95% of cash flows, to their partners as dividends. So if they meet those criteria, they are not taxed at the federal level. They get to pass through all the income and all the characteristics to the investors. The positive that these upstream trusts are typically crude oil pure plays, which is exactly where you want to be, I think, in this point of the cycle, and double so given our view on natural gas. As I mentioned, the vast majority of cash is paid to investors. I like getting cash back, rather than just getting stock appreciation or partnership, unit appreciation. They're managed by trustees with low operating costs. Some of the trustee expenses are lower than an admin's expense of a CEO at a large E&P. And then something I really like is they're very inefficiently priced due to lack of institutional ownership. So most hedge funds, mutual funds, et cetera, can't own them either for, we have ERISA rules in the U.S. where pensions can't invest in these types of assets because they can, basically invalidate their tax-free status, or because they issue K-1s, oftentimes very late. And so it makes it hard for an investment partnership like a hedge fund to provide an on-time K-1 to their own clients. Negatives, K-1s are complicated, and there's also legislative risks. So if Congress decides they want to eliminate this, which a couple times in the past there's been at least a bill introduced or discussions of it, the sector becomes very volatile. I think right now that's actually swinging the other way. As we'll talk on the Viper Trust, the current tax code with the lower tax rate and accelerated depreciation is actually creating an incentive to go from being MLPs and royalty trusts to just becoming C Corps, because companies are finding when they rerun their taxes under a C Corp status, they wouldn't have to pay taxes anyway under the current tax code. And that's kind of what's behind Viper's transition, VNOM, which then gives them a much broader investor base. Negatives is also they're managed by trustees. So there's no active management team. There's nobody to call sometimes, or nobody's putting out a slideshow or telling you next month's or next quarter's production. And then same thing as something I really like, something I really hate, is they're very inefficiently priced due to lack of institutional ownership. So they can be very volatile day to day. They can go for kind of months at a time without reflecting, the fundamentals or the pending distribution increases. So the first one we'll talk about is the VOC Energy Trust. They have about 60,000 total acres, 16,000 in Texas, which is really what matters. Their termination is no earlier than December 31st, 2030. So in the world of trusts, they're a pretty long-lived trust. They did trade last week at $5.36 a unit and paid 18 cents in the most recent quarter. And that quarter was based on December through February WTI production. So they got $61 WTI translated into a 72-cent annual dividend. That places them at about a 12.7% annual yield, which isn't bad, but not necessarily super exciting. But when you go forward, they should pay about 92 cents at $70 WTI, which I do think will be at 70 or above going forward, and we can talk about that in Q&A or offline tonight. And that's a conservative number that assumes they step up capital spending and they assumes they make some reinvestments. They could pay well in excess of $1 if they decide not to do so. I didn't want to put it on the chart necessarily, but at $100 WTI, which I don't think is a 0% chance, they would pay $1.71 annual distributions, which would be a 32% current yield. Switching over to the chart on the next page, so the white line shows the VOC unit price over the last 5 years, and what was a red line, which I think Adobe turned into an orange-yellow line, was the quarterly distribution in cents on the left-hand scale. Pretty close relationship. They typically trade at kind of 10 to 12% yields for most of these trusts. And then the red line off to the right shows that they should be paying about a 23-cent annualized distribution at $70 WTI. So if you look back in 2017, they kind of traded in the 4s to 5s, a good, say, $1 or so downside from here, which is relatively tame considering crude was trading under 50 for most of the year. The risk is greatly reduced if you can clip a few 23-cent distributions along the way. And the flip side is, if there's $2 to $3 upside on the units and, maybe a 2 to even 3 year cycle of making $1 a year, there is a potential to earn 100% total return over the next couple of years. The next one we'll discuss MVO Trust. They're located in Kansas and Colorado, and part of what makes them unique is they produce oil from just about 1,000 sipper wells. Like they average 2.17 barrels a day per well. So almost no decline. Like every once in a while they'll go out and replace some equipment and boost production a little bit and kind of maintain it that way. Very stable, steady operations, 100% crude oil. They trade currently at about $10. They were just over $10 a share this morning with a 36-cent most recent distribution. It's like $1.46, call it $1.50 almost annualized. But again, that was based on December, January, February production and pricing of $61 WTI. So at current, at $70 WTI, see in the matrix, they pay about $1.78, and that again assumes increased capex. It'd be just over $2 if they actually don't step up their capital budget, which probably won't happen for a few quarters. And then again, not on the chart, but if WTI did go to $100, they would pay $3.41 of annual distributions. Turning to the same share price and quarterly distribution graph, you can see last year, they traded, kind of low to mid 5s, sometimes higher 5s. So there is a little bit more downside in MVO. Flip side is, $2 a year of annual distributions. Even 1 year of $2 distributions takes away about half your potential downside if oil moves back under 50. Looking at the other way, however, if they're paying out 45 cents a quarter, this chart kind of suggests $15, $16 unit price, $5, $6 upside, as well as collecting $2 a year along the way. So reasonable chance of getting 100% return. If you're feeling, I guess, kind of frisky, the BPT Prudhoe Bay Trust is really controversial. I mean, you can find about 25 articles on Seeking Alpha talking about how this is the biggest scam in the history of E&Ps and going bust tomorrow and everything else. The underlying problem is, so it was created in 1989, and rather than having a typical calendar day maturity, saying it expires the next date, as you see on the bottom two lines, they have a built-in cost inflator in the cost per barrel charged to the trust by the operators. And the cost charged to the trust have nothing to do with the actual economics of producing the crude. Like these costs will be charged regardless of what it actually costs to produce. And so you can see in the bottom couple rows, they go from about $38, high $38 in 2018 per barrel, not too bad, to 47 in 2019, 53 in 2020, and by 2025, assuming like a 2% CPI, that is a part of the equation, they'd have $89 cost per BOE. So it effectively terminates, somewhere before 2025 or, pretty close to it. With the current $70 WTI price, however, this $29 trust pays $7.94, about $8 per year. And the leverage is massive. So if crude went back to 50, you'd see they pay about $2.90, call it $3 a year. In which case, your next 3 or 4 years of distributions isn't worth a whole heck of a lot. Flip side is if crude goes to 100, you would make $16 a year of distributions on your $29 trust. And the other way of looking at it in terms of like an MPV, to get $16 of distributions, you need $100 crude in 18, you need 108 in 2019, and 114 in 2020. So there are kind of wild upside scenarios where this could turn into a massive home run, but it's more of a trading vehicle and kind of an opportunistic vehicle than both long and short, than necessarily a long-term investment. Although our NPV models based on the current crude forward curve actually shows it's a buy and it's a few dollar accretive here. Next slide, we show a similar chart, which I didn't necessarily want to put the distribution level because I don't want to imply it's going to $70, which the current distribution would. You can kind of see as well, though, that prior to 2016, it traded much like the other trusts. The unit price follows the yield with various lags and leads. Beginning in 17, though, as this cost inflator issues become more common and closer to a theoretical termination, you're starting to see a wider and wider divergence in the unit price and the quarterly distributions. Last one, I think, is one that a lot of people in the room kind of know and love. Viper Energy Partners, which is really a subsidiary effectively of Diamondback. It's their what was MLP subsidiary that on May 10th converted to a C Corp. For the reasons I talked about before. When they looked at their current tax position, they had some tax loss carry forwards as well as accelerated depreciation, lower tax rate. They decided they wouldn't really pay any federal income taxes if they converted and became a C Corp, and they'd go from having just a few % of U.S. institutions able to hold them to pretty much everybody. They paid in the most recent quarter, they paid 48-cent distribution off of 14,100 BOE a day production and $61 realizations. I'm getting like 62 to 64 cents for the Q2 distribution. A little bit dependent on the next couple weeks of oil prices, as you'd imagine. But based on that, they've historically traded at about a 6% annualized yield. And when you look at the potential production growth, and it's Diamondback that still makes the majority of the production decisions because they are the largest operator on the property, they should be, for this year, they should pay out between $225 and $292, depending if crude is between 60 and 70 a barrel, and that does include some discounts for Delaware basis and West Texas gas and oil trading at discounts, which we'll talk about briefly in a moment. But when you look out to next year, the green shaded boxes for 2019, using between kind of 20 and 21,000 barrels a day of production, they can pay anywhere from $268 to $366 a unit. If you were to take kind of a mid-range estimate of $3 a unit, and say a 6% yield, you're talking somewhere in the mid-40s for unit price. And I think there's an argument that historically they've traded a 6% yield, but not only has their production growth accelerated, but now they're a C Corp. If they traded at a 5% yield, and again, I don't know what yield they're going to trade at, but 5% yield on $3, You could have a $60, $50, $60 stock pretty easily. So talking about other themes for a moment, I did a call for Keith's Conversation clients 2 weeks ago. And one of the things we talked about was the Delaware producer price realizations. So this is the slide that we used for that discussion. The point being that the dark box with the $31.10 in it is what we estimate the average U.S. E&P got per BOE in Q4. And that was under, kind of a $55 WTI scheme and $3 Henry Hub. While the average E&P has moved up to $35.44, with $70 WTI and kind of $2.75 gas, when you incorporate the Delaware discounts, both for Waha oil and natural gas, you're actually seeing closer to $28 realizations in West Texas. That's something that I think, a couple presentations have highlighted probably gets worse before it gets better. It's a temporary thing, this too shall pass, but for the next 6 months to year, that's going to be a real risk to Delaware and West Texas producers. And as Keith had pointed out, Kellen, he was able to sell before the $2 fall, partially as a result of this realization. The other thing I should point out that isn't necessarily blocked in this table, the $35.44 price today at $70 WTI and $2.75 gas. If you scroll up and assume gas falls to $2 or somewhere there close to, you end up back at about $31 to $32 total realizations, and not much better off than you were in Q4. I think that would be a problem given the tightness of global oil supply demand. So ironically, lower natural gas price should lead to a much higher crude price as E&Ps try to be incentivized to continue drilling, which I do think kind of requires a mid-30 total realization. So falling natural gas prices will be good for headline crude oil prices. So transitioning to natural gas, this chart is one of my favorite charts we produce a couple times a year for our clients. The bluish purple bars show the year-over-year change in the U.S. natural gas directed rig count. The percentages are off on the left-hand side. The red line, which actually showed up red, that's the total U.S. dry gas production in BCF a day. So a couple important things. You can see just how big this increase in the rig count was relative to historicals. And the other, you can kind of see the leads and lags and the production response that happened. There's roughly a 12-month production response from really robust increases in the rig count to dry gas production. We're just hitting that sweet spot. We're starting to kind of lap the April through September, October rig count surge last year. And so if you look toward the far right, we're at just under 80 BCF a day, or maybe just over if we didn't have pipeline maintenance. Where the blue-purple bars end is where our forecasts continue. We can get 88 to 90 BCF a day by year end with the current rig count, just extrapolating recent trends and looking at our rig productivity models. And what's interesting right now, so this assumes the current rig count, the wintertime strip now has been kind of the 305 to 310 range, with January gas being 315 to 320. A producer, especially drilling a pad, but even looking at the normal lags from contracting a rig to first production, a producer would want to contract a rig in the U.S. in kind of June, July, have production coming online in November, in time to hit that wintertime surge. So I actually think we're about to see an upturn in the natural gas rig count in the U.S. At a time where it's the last thing we need. So this just shows the EIA weekly report from the most recent weekly update issued last Thursday. Punchline being, if you look at the second row down, dry gas production, last couple weeks has been, kind of high 79s, 79.7, 79.5 BCF a day versus 71.6 last year. So we're up about 8 BCF a day. And finally, for the first time in months, we've had two weeks of relatively normal weather after having an incredibly cold January and incredibly cold April, which is what's pushed out our negative gas thesis from spring to fall. We can look at year-over-year comparisons in demand, and it turns out if you look at the bottom row of the EIA table, demand's kind of running 70 to 72 BCF a day, with a little variability from weather, versus 70 last year. in our models on a really simplified basis, we should be picking up about 1 BCF a day of demand from increased LNG exports. That includes Dominion's Cove Point ramping up, and 1 BCF of demand from kind of a structural shift from coal to natural gas and just new natural gas generation. So we should be running about 2 BCF a day of demand against, as you saw on the previous slide, production that's up 8 B a day now, going to potentially 12 or more come late fall into year. So it's a little early on a natural gas outright short position, but it's the most oversupplied market I've ever seen in my 20 years of doing this, and one of the biggest train wrecks still coming down the track. It hasn't entered the tunnel, but you can definitely see the headlight if you just bother to look. I think with that, if there's time, we'll see if there's any questions.
Yeah, there's time. Can I ask a question about producer discipline? When you talk about the oversupply situation, is there no producer discipline as far as not drilling as many wells, or are they so linked to bank loans and so forth they have no choice?
Yeah, I mean, so the question is there producer discipline, or will there be? And I don't think so. I mean, it's such a fragmented space, and we did a cost study, I guess it was in March, using 2017 data, and we calculated the average all-in production cost, including interest expense, SG&A, overhead, was $1.76 for natural gas production in the U.S. And that wasn't looking at production costs from oily producers that just kind of tend to produce gas as a byproduct. So there could be discipline, but it's not at $3. I don't even think it's at $2 gas. Like, I think you have to see sub $2 gas to even consider a downturn in production and slowdown in rig activity. Yeah.
How would you play the oversupply natural gas?
I mean, it's tough. I mean, there's almost no gas producers anymore. The couple that are left are all buying oil land in West Texas, which it kind of makes me, I guess, smirk, to say the least. They go from one oversupply disaster to the next. So that really leaves the ETFs. Things like the UNG, the U.S. natural gas ETF, it historically underperforms 25 to 30% from what just the front month, headline price on your screen does, because of the cost of rolling contracts and contango, and similar thing. The UGAZ, which is a 3x, UGAZ. It's basically a 3x version of the UNG that has all the same problems, just 3 times multiplied. It can give you a heart attack if you have a big position and it's a volatile day. But in the long term, if you look at the long-term chart, which I wish I could pull one up, I mean, it's one of the most amazing value decays you've ever seen.
Well, those oil trusts, they're pretty volatile.
They are. I mean, they were up, kind of 5 to 7% today. The production itself can be volatile as well. If there's some kind of hiccup on a pipeline, or a customer didn't pick up a shipment, because these are small, typically 2,000 barrel a day companies, the distribution moves several cents, and that can give you, 10, 20% price swing over a few days. And so you definitely want to have a portfolio approach, because most of the volatility is really stock specific, unless there's some kind of legislative risk or, major hike in interest rates. But if you put together a reasonable portfolio of at least 3, 4, 5 names, that helps. But you're always going to be faced with, I think, above average volatility.
So I guess you wouldn't have a favorite one, and you just.
I mean, I'd probably answer this way. So my dad's in his mid-70s and has no income and retired. He owns MVO, VOC, and Venom. Those are the only 3, out of the whole trust universe that he owns, in roughly equal portions as well. So.
What happens if you own the units at the expiration date?
That's actually a good one. My associate Al, who's with me, has been doing a lot of work on that. You can corner him at drink time, but it's basically one of 3 things. It can terminate with no value. Sometimes in the agreement it says that the underlying royalty reverts back to the parent or just disappears. That's less common. Second thing is it can go through an auction, which is typically very inefficient. So it gets sold, the lawyers get their stake, you wait a year and then you get a small check. And the third is, in rare cases, you actually can make money. It turns out, like VOC is an interesting example. Like, their land position, I think, could be worth over $10 per unit. You know, or Enduro is another one that, you know, right now it's kind of controversial because the parent's going bankrupt, but really interesting land base, you know, just whether or not they could ever monetize it, or, you know, you and I as common unit holders would actually get the check.
So even if they conduct a C-Corp, they still have to wind up?
That's a hard question. So the trust will have to renegotiate their trust agreements as part of that C-Corp conversion. And so it'll be at the whims of the parent to, you know, A, allow it, and B, you know, what they want in exchange. In a lot of cases, the parent owns a lot of the shares. And so that, you know, like in the case of Venom, where the parent owned, you know, roughly half of it, or actually, you know, actually more than half, but, you know, in that case, it's creative, share price goes up, everybody's happy. But in other cases, you know, they don't actually have a shareholder interest in the common units. They just have like this overriding parent GP unit. And so they don't necessarily want, you know, you and I as LPs to benefit.
Okay, Nathan, thank you. Our time is up.
Thank you.